Finally, I'm back again after getting my teeth fixed. Now that I can talk better, let's see what's happening. As much as it has been quite some time since the last time I made a video about Trump, no worries, since then it was still all about tariffs. Starting from how countries going to him to make deals, some said they are confused. Japan wanted a tariff to be completely gone. The UK seems to be made an example of a good trade even though they still have 10% on them. EU being said to be hard to negotiate. With that, Trump threatened with a 50% tariff starting from June just because he thinks it seems just right. And the biggest one of them all, US and China tariff talk that resulted in a 115% decrease. Yes, 115% decreased on both sides. 10% tariff on US left and 30% tariff on China left, from 125% and 145% respectively. So yeah, if I have to summarize what was happening on tariff, everything is still a huge work in progress, which means no certainty yet. In fact, the tariff cut between US and China is only for 90 days, so who knows when this is gonna end, right? It could be a year from now, it could last for his whole second term in fact, right? So who bends first? I let you guys decide, but one thing for sure is that China is tough, and it turns out that China has their own cuts, not just Trump. Regardless, I will say what I've been saying on my Instagram posts: stay nimble, folks. It's all Trump's narrative at this point, and it has a global effect, that's for sure. Just look at the headlines, alright? But there is one thing that caught my eyes the most. Not the good data, CPI, PPI, employment data, no, not all those. It is the US Treasury yield. Their long-term yield has touched 5%. And so, we will talk about what Treasury bond is, what impact it has, and its importance. With that, grab a drink, sit back. I'm Daddy, and this is That Money Compass. Sorry, but before we continue, I just want to mention this thing really quick. Harvard was first getting its funding frozen, and then it was banned to take in foreign students, which make like 27% of the population, and as such, foreign students are at risk of being deported. Harvard now tries to sue, but what do you think? What do you think will the result be? One thing for sure is that it may take a long time for this to settle, and Trump has like 5 years for this term. What will the students' fate be then? One thing that is for sure, I realized that government can literally do anything. I'll leave it at that. But what about the yield? Alright, because that's the topic for today. We all know that US is the lead country in this planet Earth, but other countries have been steadily making progress in reducing its power. One example is by de-dollarization, which is done by BRICS, with more countries joining it. Russia and China trading with either crypto or their own currencies, especially for China whose focus is on yuan, and Trump giving countries more and more reasons to doubt the dollar, as well as all the risks that got introduced, risking the dollar even more, and inflation. It almost sounds like a perfect storm, to be honest, now that I've said it out loud. Let's look at the chart. Alright, it shows the charts between 4 assets: gold, S&P 500, 10-year yield, and the dollar. But we can see here is that the dollar has been on a steady downwards movement. I believe if you check your currency as often, you would have noticed how our Singapore dollars is getting stronger as compared to the US dollars. For S&P 500, it went back up after the good news of pausing tariffs. Gold, it had been on an uptrend, signaling that people still sought gold, especially China. Why? Look at the bond yield. If you have watched all my previous videos, I had mentioned how China had been selling the US bonds, and on top of that, they have been buying gold. So 1 + 1 = 2, right? I mean, look at this. This is basically the treasury, the foreign holdings of US treasuries, basically how much other countries is holding the US treasuries. And isn't this crazy or what? Look at how the chart continues to go down for China, while Japan's has been sideways. This explains a lot, guys. So it seems like US bonds definitely have a global impact, and all these have something to do with the dollar, as well as its domination in this world. So what are US Treasury bonds and yields anyway? A bond is like an IOU kind of thing. It is a debt. It is like I give you something, but in return you give me money. So a US Treasury bond is like an IOU from the US government. They issue bonds to borrow money, usually is to fund themselves, could be to pay off debt, could be to pay something else. Watch my other videos for more contexts, but investors buy these bonds and in return the government pays interest called the yield. This is the most common one that we also know in Singapore, right? Treasury bills, SSB, these don't sound foreign, especially since the pandemic. A lot of people have been buying those. Then the yield moves opposite to the bond price. When prices fall, yields rise. When prices go up, yields fall. So basically it's like a vice versa kind of thing. Why are these bonds a big deal then? They are considered the safest investment in the world, backed by the US government, which is the #1 country right now, and also which has never defaulted. Because if let's say a country or a government has ever defaulted on their own bond, this will reduce the trust tremendously, and this can affect their reputation. Alright, so foreign countries like China and Japan and the other countries that you see in the chart, and also in fact recent as Tether, which is the company that issued USDT in cryptocurrency, has gone into top 20 of US Treasuries holders. Alright, and basically they hold about $8 trillion and using them to manage their dollar reserves. Alright, and that makes US bonds the backbone of global finance, tying the whole world to the US economy. Okay, because everybody is having the dollars as a reserve, they all trade the US dollars, and also they have bonds. Yeah, pretty much the whole world is tied to the US at this point. Alright, so one thing you have to know after understanding the definition of this is that the bond yield itself, they have different yield periods, right? Like for example, there are those that mature in the short term, there are those that mature in the long term. But in the US, there are basically 5 different yield periods, starting with the 2-year yield, 5-year yield, 10-year yield, 20-year yield, and then the 30-year yield. There's 50-year yield as well, but that's just too long, so we are not going to talk about it. Alright, so I used to get confused as to why people tend to look at certain periods only, and very often you would hear how people compare the 2-year yield and the 10-year yield. Then recently, with all the news about bond yield, I started to see people bringing up the 20-year yield, which I myself only ever took a look less than 5 times so far. So what the heck are all these, right? Why do we need so many of these? And if you don't know, the 10-year yield is actually one popular yield that people sure look at. So why? First thing first, these different yield periods simply represent their maturities periods, like how you have already know. So from short to long, but here are the typical differentiation. So the first one is the 2-year yield. It's typically for short-term view. Fed policy changes typically affects this the most because of the sensitivity. A rising 2-year yield often means the market expects tighter policy. 5-year yield though is typically for mid-term view. It reflects medium-term growth and inflation expectations. 10-year yield, which is commonly known as TNX, is also for mid-term view, but also the global benchmark. Rising yields signal inflation fears, while falling yields suggest economic slowdown or safety seeking. It is the most liquid one as well. In fact, the most liquid asset out there just because everybody trades it, including countries. 20 and 30-year yield though are considered long-term, but 30-year yield seems to be the one that the big boys seem to be looking at, simply because it is often used by pension funds and for gauging the health of long-term US debt. This last one is very important. So there are also 50-year yield, like I said, but it's not commonly referenced. Perhaps it's just too long. 20-year yield is also actually not often referenced, but you do see them used by retail investors here and there for long-term reference. But why 10-year yield and not not 20 or 30-year yield then. Everyone watches 10-year yield. It is the most traded, making it the go-to pretty much for pricing loans worldwide. So yes, like housing or any loans you can think of, yeah. So out of all, only 4 are typically referenced: the 2-year yield, 5-year yield, 10-year yield, and 30-year yield or 20-year yield. It's up to you. You can use these two interchangeably because by looking at the charts, their yields are not that much different. So yeah, you can use them interchangeably. But if we piece all together, it makes sense why 2-year yield and 10-year yield are the two that people reference the most. Is because one is for short term, one is for longer term, which is usually tied to all sorts of loans. Alright, so the next question is, how is US bonds so important then? What's its role globally, right? So first, they are a safe haven asset. When chaos hits, like tariff war in April or any sort of war, investors flock to them, okay? Second, the 10-year yield sets global borrowing costs. When it goes up or down, it influences not just the corporate bonds, but also loans like mortgage rates in other countries, simply because US is the country and hence its rate is the benchmark. Okay, when it spiked, Japan's 30-year yield hit a 20-year high, for example, and hence its rate is the benchmark. Okay, so for example, Japan, let's look at Japan because Japan recently has got into the headlines, right? So when the US yield spiked, Japan's 30-year yield hit a 21-year high, and Britain's hit a 1998 peak actually. So any other countries actually got affected too as the US yield spiked, right? But why Japan made headlines then? They hold 1.1 trillion US dollars in US bonds. They are basically number one holder here, and their massive debt market felt the hit pretty much. So yeah, I mean, who doesn't like juicy news, right? And last but not least, third, dollar reserves. 60% of global reserves actually. So these tie countries to US monetary policy pretty much, which means that if something not good happening to the US or its dollar value is taking a hit, this ripples globally. Okay, so that's why US bond is very important. All right, I'm going to explain more later. Okay, so why are US Treasury bonds so important then? These bonds, all right, they fund the US $1 trillion of debt. Okay, if you have watched all my previous videos, I've actually mentioned briefly how the debt works, how Treasury, debt, bonds, and Fed kind of play a part in this debt kind of thing. And bonds also keep the government running. Okay, otherwise you keep hearing them announcing that the US government may be shutting down or something like that. Okay, so the Fed uses them for policy like quantitative tightening or QT, which pulls the money out, like $5 billion less in treasuries monthly, pushing yields up, or quantitative easing or QE, which does the opposite basically, like in 2020 with $5 trillion in purchases. So it's like the opposite kind of thing. So treasuries also underpin trust in the dollar and the economy, and with $8 trillion held globally, this means that the world pretty much trusts the US. Okay, and that explains the domination of it. All right, but when China dumped 759 billion US dollars in bonds in April, this shows the cracks in that trust. Okay, and just like anything else, because even way back then, when during the Stone Age or whatever, we tend to value things, and that's how we kind of purchase stuff or doing trades. Just like in carousel, for example, when you are selling your expensive bike, you don't expect to trade it with a packet of Indomie, for example. You don't even want to accept a carton of it, right? Because you know that your bike has certain value to it, and hence you expect the same amount quantity of stuff of the same value. So the same thing for money is that it's all about trust, right? Because otherwise money is just a piece of paper. Okay, so that's just how it works. And back then everybody trusts US. I believe it was mostly because US was the most powerful back then, so that's how it goes, right? But at this point, things have started to change, right? We all know that China has been, trying to reduce US power, and then there's this formation of BRICS. So yeah, we can see that things have really started changing, but it's not enough, because literally globally we are all still using US dollars, right? But again, the fact that there's this action, it just shows that there's crack in the trust. So back to us, why do people check different yields then? People check different yields to read the economy. The 2-year yield tracks the Fed rate expectations pretty much, which leads to monetary policy like QT or QE. The 10-year yield shows medium-term inflation fears, like the 4.5% we see now. As it goes up, people started to talk about it more and more. The 20-year yield and the 30-year yield at about 5% reflect long-term trust. So when it hit 5%, this signals there's something not right, and either people are selling or countries are losing trust in bonds, which is why you started to see all this in your phone notifications or news notifications or whatever. Okay. Additionally, comparing them gives us the yield curve, like 2-year over 10-year, and it's inverted. It signals a recession. A recession is 6 months of shrinking GDP, or at least that's what we know until the US government altered the definition itself. But generally, this means jobs vanish, spending drops, businesses struggle, which is more like a circle, because when rate is high, people just stop spending, which then affects companies' earnings and revenues. This in turn results in investors selling their stocks and companies wanting to cut costs, trying to maximize their earnings, leading to people being laid off, which means they cannot even spend, which then causes companies to suffer even more. And this kind of creates this downward spiral. Alright, so this is recession. Hence, you often hear Trump saying, oh, our jobs data is great, but jobless claim is less, unemployment rate is steady, inflation is coming down, economy is doing great, right? Right. But yeah, looking at the bond yield charts earlier, we also can see right now there's no recession yet, because all of them kind of move in tandem, right? So I can't predict, but some US banks have specified recession chance of like 50 to 60%, but I'll leave it to you whether you believe it or not. But one thing I can say is that don't trust analysts' predictions too much, okay? So after understanding bond and yields deeper, there is one thing that we have to know. How high of a yield is too high? Fun fact, yields can get too high. High yields make loans pricey though. And this also means that mortgages could hit 10%, people could stop buying homes, cars, or anything big, because anything big means loans, and if high yields, it means high loans. Alright, and nobody wants that. Businesses though, they will borrow less, lay off workers, and those workers spend even less. A downward spiral again to recession. Unemployment spikes, GDP shrinks, and times get tough, like in 2020 when retail sales fell 8.7%. Alright, that's not good. 8.7% down is not good. But is there a number? Well, based on the past observations that I did, 4.5% seems like it's the mark where people start to sound out. 5% though is where the US government may start to act, and Trump will start tweeting or posting something like the US is the safest one to own. You get what I mean. I think the easiest way to imagine whether it is bad or not is by imagining how much loan rate you have to pay. Yeah. So you can decide yourself. Alright. So anyway, to wrap up, US bond yields are the world's financial pulse, basically, from funding the 34 trillion US dollars debt to setting global rates. Right now, yields are rising together, so no recession yet, but there is a chance. High yields and the trade war keep risk alive. Yes, tariffs. Tariffs can inflate stuff, which means inflation, which means higher rate from the Fed. Okay, so what do you think? How high can yields go before a recession hits? Drop your thoughts below, and if you like this video, give it a thumbs up and share it, as it helps this channel out tremendously. But if you don't like it, you can leave a dislike as well. Stay nimble, and I'll see you on next one. Bye bye.